I'm back. I took a few weeks off from doing this pod. First, maybe to give myself a break. But the real truth was the markets were reacting violently to incoming data in a vicious news cycle. I had to gear up, shut out all the noise, and make sure the ship didn't take on too much water. While February was a weak month for U.S. stocks with the S&P 500 off 1.3%, that performance masked some significant drawdowns in popular stocks like AppLovin, GE Vernova, Vistra, Palantir, all pulling back between 20 and 40%, some in just a few days. Reversion to the mean, it's a powerful force. And it was clear markets were making a defensive turn. So extracurricular activities like this pod, TV network shows, had to take a back seat to my day job, running money. So why the February hiccup? And is this just a simple reversion to the mean that should be bought? Or is there something deeper and more ominous going on that we need to understand and, if necessary, adjust our playbook? Before we can come up with some answers and a path forward, we first have to shine a light on what's working, what isn't, and what's next. Welcome to The Money Runner. I'm David Nelson. U.S. markets actually went negative for the year briefly before a bailout rally on the last trading day of the month, Friday. Markets were already weak following NVIDIA's post-earnings report sell-off Thursday. And then, of course, the disastrous White House Oval Office meeting between President Trump and Ukraine President Zelensky. Needless to say, the conversation went off the rails. Look, I'm not going to try to change your political viewpoint of the meeting, as both sides of the aisle will spin it to their political point of view. Half my Facebook followers have changed their profile pictures to "I stand with Ukraine," and the other half have photos of American flags and MAGA hats. Most of you know where I stand, and I've said repeatedly that this was a war that should not have happened. But I'm here to talk about money and how this setback might affect markets. Trading in Europe this week should prove interesting. Shares on the continent have traded higher since the start of the year, in part a reaction to the increased possibility, if not probability, of ending this very costly and destructive war. At a minimum, any ceasefire has been pushed back. Interestingly, after a push lower on Friday, the final 2 hours of trading saw the index put in one of its best performances in weeks. End of month rebalancing, or investors looking to scoop up quality stocks? We're going to find out soon enough. Before we tackle what's working and what's next, we need a top-down look at the market and economy. Really a look at the entire chessboard. The political and economic shift can't be denied. We have a new administration that's taking us in a different direction. So regardless of where you fall politically, it is clear that structural change is happening. The U.S. has been operating with massive debt and budget deficits for decades. And right now, we're at a point where the interest on our debt is now larger than our defense budget. That is not sustainable. The administration's approach, clearly a reset. What a new CEO does when they take over a company drowning in debt. That means painful cuts, restructuring, and a reset of priorities. Bond yields will be the final arbiter as to whether this plan is working. 10-year Treasury yields have come down in recent weeks, signaling some optimism that fiscal responsibility is being taken seriously. But let's not ignore the other possibility. Lower yields can also signal economic slowdown ahead. The reset we're experiencing won't be painless. Change invites volatility. If we are truly moving from a government-run economy and shifting much of the burden back to the private sector, the changeover could easily produce an economic disruption where the economy contracts before expanding. Are increased taxes the answer? That's always brought up. Not really, not from my point of view. We can debate who should be paying higher or lower taxes. That's a valid political argument. But what isn't up for debate is that on average, tax revenue as a percentage of GDP will likely be somewhere between 19 and 20%. William Kurthauser's law identified this in the 90s, examining every tax regime post-World War II. You raise taxes, generally, economic activity starts to fall, keeping your overall revenue as a percentage of GDP the same. The only other solution is to reduce spending. Market leadership is shifting beneath our feet. Without the Mag 7 and the largest stocks by market cap leading the way, upside for the broad indices will be diminished. The math is undeniable. The top 10 stocks by market cap represent 35% of the S&P 500. So, if as a group they fail to deliver outsized returns, then by definition, we are looking at single-digit performance. The good news is that there are lots of stocks killing it. It just may not be the usual suspects. Take last year's sector performance chart, turn it upside down, and you come close to what a sector performance chart looks like year to date. Last year, healthcare was one of the worst performing sectors. This year, it is leading the market. Stocks like CVS, up 46% year to date. AbbVie, 17%. Eli Lilly, 19%. They are all seeing renewed interest. The same goes for financials. Berkshire Hathaway, up 13%. Citigroup, 13%. JP Morgan, 10%. Meanwhile, the once dominant Magnificent Seven stocks have struggled. The only one in the green this year is Meta, up 14%. Alphabet is down 10%. Tesla is down over 27%. And Microsoft, Nvidia, and Apple, and Amazon are all negative year to date. This is not a death sentence for big tech, but we can no longer throw darts at a board thinking the tide is going to lift all boats. In tech world, the Chinese startup DeepSeek exposed a major flaw in the prevailing wisdom that you have to spend hand over fist to stay in the AI arms race. Necessity is the mother of invention, and DeepSeek found a more efficient way to do AI training and inference, and that hasn't gone unnoticed by seasoned tech investors. Even within tech, the chess pieces are moving. We've moved beyond the initial focus of the build-out of infrastructure and training to inference and application-specific solutions. Like I said earlier, reversion to the mean, it's a powerful force. And given the depth of the tech decline, we should see some bargain hunting very soon. Well, that's it for this week. I hope you like the show. And if you want to learn more about the Money Runner and yours truly, go to my Substack site, dcnelson123 at substack.com. I'm David Nelson, and this is The Money Runner.